watching the ET Money show, and firstly onto the show, like we were telling you, we are going to discuss about the passive funds. What are they and what advantages do they hold over and in comparison to active funds? We'll discuss all of that, and to discuss on this particular topic, we have the expert joining in, and today onto the show we have Santosh Navlani, who is the COO of ET Money. Santosh, a very good evening, and thank you for joining us on ET Now. Firstly, onto the topic, I'm just starting with the basics, and that's for our viewers. What are passive funds and why is the popularity gaining up? We have the total AUM size in which passive fund holds around 14% of the total industry pie. Why do you feel that the people are moving into this?
Hi, Srishti. So let's begin with what are passive funds first. It's very simple to understand, or the simplest form of funds that you can invest in. When we refer to mutual fund industry, we always refer to some kind of large cap fund or some kind of mid cap fund or flexi cap fund. What they essentially are is some fund manager is actually managing them as a human being, taking calls on sector allocation, weightage of a single stock, when to enter, what price to kind of average out on, when to exit, and basically manage the risk return profile of the fund. Compared to all this, a passive fund becomes a very much simpler understanding where you actually look at mimicking the benchmarks that are heavyweights in the marketplace today. So whenever we refer to what were markets today, we typically refer to Nifty or Sensex values, and that is basically what drives the sentiment in the marketplace. Nifty was up by 1% or Sensex was down by 1%. And when you refer to this and you wish to really say that which my portfolio exactly was like, if Nifty was up by 2%, my portfolio goes up by 2%. If Nifty was down by 0.5%, my portfolio will be somewhere around 0.5% down as well. If I wish to do that, the only way you can do it on a day-on-day basis, in a almost like mirroring this, is by way of passive funds. So they see a low-cost version of active fund because there is no fund manager. What happens is a passive fund actually deploys your money in exactly same proportion in different sectors and stocks as the constituents of the benchmark. So if Reliance Industries is about 10% of Nifty, then if you buy a Nifty index fund, 10% of your money would be in Reliance Industries, and so on and so forth, the different stocks. So it is one of the lowest cost way to invest. Very, very simple to understand that you're actually buying Nifty, you're actually buying Sensex, or you're buying a mid cap index, or you're buying a small cap index, or you're buying a broader Nifty 500 index when you're buying a passive fund. So it becomes a very easy way for a lot of retail investors to understand how the fund would be managed. The advantages are very simple. It's a low-cost way to invest in markets. A typical large-cap fund or actively managed different category of equity diversified funds would charge you an expense ratio of 1.5 to 2.5% depending on regular or direct plans, respectively. And if you look at the passive version of these, they will be like in the region of 0.1 to 0.3%. Now, that itself saves about 1.2% cost on an annual basis, and that adds to your extra returns. And that returns is where the basically your extra sometimes outperformance also comes in compared to actively managed funds. And second aspect is there is no fund manager bias in this. So when a fund manager is basically managing money, ultimately he or she is a human being, and he or she would have his preferences about his investment style, what kind of sector he likes, what kind of outlook he has, what kind of stocks he prefers or to invest in, to get out from. That biases come into picture, and a passive fund is completely free of biases. If Nifty is 10% Reliance, the Nifty index fund may actually have 10% Reliance. If Nifty tomorrow reduces weightage of Reliance to 8% or goes up to 13%, your index fund actually automatically will move the Reliance weightage to 8 and 13% respectively. So you basically are just mimicking the performance and expecting the long run that your returns will be exactly like Nifty after expenses, or rather before expenses, sorry. And another advantage is there is no dependence on the celebrity fund manager. Sometimes if a great fund manager who has extremely good track record is managing the fund, then typically you'll pay a premium in expense ratios of that fund. And that is basically saved off as a cost as well as dependence from the fund manager. And third aspect is you get what you expected. So when you're buying a large cap fund, as per SEBI regulations, 80% of the large cap funds assets should be invested in top 100 stocks by market capitalization. So at 20% can be mid cap, can be small cap, can be even micro cap for that matter, or sometimes even cash calls can be taken in the fund. But when you're buying a Nifty index fund, you are guaranteed that all your money is invested in Nifty index stocks only, and all you're getting is large cap stocks. So what you get is what you is exactly what you expected from an index fund compared to when you buy an actively managed fund.
Yes, absolutely get your point, Santosh. But I'll come to the comparison of the active and the passive funds. But before that, when we see that the majority of the AUM in this particular fund is driven by the investments made by the EPFO, that's Employee Provident Fund Organization. As a retailer, if you could just highlight for our viewers, what are the options that are available for them so that they can invest in all of these passive funds?
Yeah, so Shishri, there are a lot of almost many fund houses these days are launching index or passive variants of different benchmarks in the country. So if you were to really go after investing in large cap, you would find a lot of Nifty 50 index funds. There is even an AMC which offers Nifty 100 index fund for large cap investing. There are a lot of fund houses which offer Nifty Next 50 index fund, which is the after the first 50 benchmark in stocks, a part of benchmark index Nifty 50, then most liquid stocks, most liquid 50 stocks are part of Nifty Next 50 index. So there are a lot of funds available which are mimicking the performance of that fund, of that index, and offering Nifty 50 index funds versions of themselves. There are options in mid cap and small cap space as well. A lot of companies offer Nifty Select mid cap index fund, which is basically mid cap 100 index version of Nifty. There is a lot of funds offering Nifty mid cap 150 index fund. Small cap versions available, small cap 250, small cap top 50, Nifty 500. So there are various options available. What is important for investor to understand is what kind of market cap exposure he or she is willing to invest in. If he is wanting large cap exposure, the Nifty 50, Next 50 are the good options.
Okay.
If somebody is wanting broader exposure in marketplace, a Nifty 500 is a good option.
Okay, absolutely get your point. And Santosh, like you were highlighting, what advantages do they hold over active funds? I'm absolutely convinced with that. But I would like to know, is there any data point to support that over the years that now these active funds, now passive funds are offering you better returns? Is there any data point to support how have they performed better in comparison to the active funds?
Oh, absolutely. Over last decade or so, there is enough history available now that what kind of funds are able to outperform their respective benchmarks and what kind of funds are not able to. So if you really look at entire history of say last 10 years, you would notice that if you compare all the actively managed large cap funds performance against their benchmark, say Nifty 50, you would notice that almost depending on 1, 3, 5 or 10, 7-year kind of a period of observation for returns, you would notice that at least 2/3 to sometimes even 80 to 85% of the actively managed large cap funds fail to beat the benchmark Nifty 50 index returns. And that is very, very kind of, difficult to convince oneself to why one should actually invest in large cap fund when it becomes a probability of less than a coin toss to outperform the benchmark index in that sense. So it becomes more of a serendipity or one's luck to really be able to pick a large cap fund which ends up outperforming the Nifty 50 index returns. So in large cap, 2/3 to 75 to sometimes 85% of the funds fail to beat the benchmark. What we've seen in mid cap kind of space over last 10 years, while the performance over last 10 years, 7 years is pretty healthy, where less than I think 10% funds fail to beat the benchmark returns of mid cap. But when you look at recent year performance of 3 and 5 year period, you would notice that almost 50% of the funds fail to beat the benchmark returns of mid cap index. And again, it becomes a coin toss that whether the fund that you will pick up, whether that fund will be able to give you the returns over and above the benchmark or not. It becomes again the question of selection going right for yourself or not. But in small cap space, there is still alpha. Over there, what is happening is almost 80% of the funds actually end up outperforming the benchmark index returns over long periods of time. So if one is considering investing in large cap space, it makes sense to stick with index funds instead of spending a lot of time in researching what kind of large cap fund to buy. In mid cap fund, there is definitely a sense in buying some portion of your money into passively managed mid cap fund, some portion maybe can go into actively managed fund. In small cap, there is still to be case build up for index fund. But if you look at our portfolios, how we construct generally when people individually invest on their own decisions or take financial advice, the allocation to small cap part of the market is very, very less, to the tune of 10 to 30% for many maximum people. And for that kind of small allocation, it may not make sense to really go after an actively managed fund. So for small allocation like a 10%, it may make sense to stick to a index fund, but only when you are allocating large portion of your wealth to small cap space, that's where you need to probably go after an actively managed small cap fund. So it's pretty simple to look at performance and understand that most funds in the large caps are failing to beat the benchmark. And for mid cap, small cap, as I mentioned, there is case for some amount of portion to be going into the actively managed funds.
Absolutely, Santosh, and even I was really amazed to see how over the years the passive funds have actually outperformed the active funds, the return expectation in that one. But one aspect within the active fund is that you get a lot of options. You can actually diversify. When we are talking about the passive fund, it is more like a replicate of the index that is there, be it a large cap, be it small cap, or any index of so matter. But basically, how can one look to diversify using the passive fund? Is there a strategy now that the mutual funds also offer passive debt fund options? How do you look at this particular case?
Yeah, so actually, it's far easier to construct a portfolio for long-term using passively managed funds, Shishti, compared to actually looking at only actively managed funds. And there is a reason. One of the things I mentioned a few minutes ago is one of the biggest advantage of passively managed funds is what you expect is what you get. So when you are buying a Nifty 50, Nifty Next 50 index fund, you know that your money is actually going only towards investing large cap stocks. When you're buying a mid cap, all your money is going into mid cap stocks. But when you're buying an actively managed mid cap or small cap fund, as per SEBI's regulation, as long as the mid and small cap funds invest at least 65% of their corpus into mid and small caps respectively, they can be classified as mid and small cap stocks or funds. And 35% of their monies can actually go in large cap, can go in mid and small caps or whatever, it doesn't matter. And that's where the problem goes in portfolio construction. When you are, as an investor, constructing a portfolio which is diversified across mid, large cap and small cap space, buying an actively managed fund which actually ends up investing 35% of your monies into large cap stocks actually creates portfolio overlap, which actually means that you are thinking you're diversified, but you're not diversified. And that's where the problem lies in our opinion. And hence, it's far more easier to construct a very segregated portfolio across large, mid, and small cap space by buying index funds version of themselves. And you mentioned debt part. Even in debt fund, a lot of innovation happening in this place where we've seen with the start of Bharat Bond Fund by Edelweiss, where you actually can get to buy into PSU debt papers or sovereign backed companies debt papers, and these are more of target maturity funds where the money would say invested into buy and hold kind of mode, or maintain the maturity into these papers for 10 years or 5 or 7 years. There are different versions available for bond index fund, and a lot of state development loan index funds are coming in the marketplace. Again, very, very passively managed, active calls of interest rate duration, duration calls or credit risk calls in that sense coming into picture. We've also seen launch of cost and maturity funds, which is like equivalent of putting money in 10-year GSEC all the time. There are possibilities of 5-year index ETFs coming in the marketplace for GSECs. So there is enough scope available to really construct a well-diversified portfolio across equity, debt, even gold for that matter, by buying just mutual funds passively and manage your rebalancing far more effectively than actually you can do by actively managed funds.
Okay, and that's really interesting to see how within the passive funds also you have like so many options, not just in equities. Either you can go in gold and you can also consider debt as an option. With this, thank you so much, Santosh, for joining us today on ET Now and sharing your perspective and how the passive funds are really taking over the active funds and they could be a better option for the investors as well. Thank you so much for your time.
Thank you.